Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Genscript Biotech Corporation Annual Report. Genscript Biotech Corporation offers a diverse range of businesses and services across various industries. The company operates through three main segments: life science services and products, biologics development services, and industrial synthetic biology products. The Life Science Services and Products segment provides products and services in several categories, including gene synthesis, oligonucleotide synthesis, peptide synthesis, protein engineering, antibody development, and life science equipment and consumables. These products cater to various fields such as biology studies, pharmaceutical and drug discovery, disease diagnostics and vaccine, agriculture, environmental studies, and the food industry. The Biologics Development Services segment helps biopharmaceutical and biotech companies accelerate the development of therapeutic antibodies and gene/cell therapy products through an integrated platform. This service is designed to support companies in their research and development efforts. In addition, Genscript Biotech Corporation's Industrial Synthetic Biology Products segment develops and produces industrial enzymes using non-pathogenic microbial strains constructed through genetic engineering. These enzymes are used in various industries, including biotechnology and pharmaceuticals. Overall, Genscript Biotech Corporation offers a comprehensive range of products and services that cater to the needs of various industries, from life science research to industrial applications. Genscript Biotech Corporation maintains a market capitalization of $25 billion, broadly in line with the industry peer group. Genscript Biotech Corporation trades at a lower price-to-book ratio of 0.71 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 18% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. A substantial increase in license revenue has been a significant contributor, with notable growth from other business areas as well. The life science segment has seen an impressive 79% increase, while the synthetic biology products unit has generated significant revenue in its first year. Biologic services and development have also experienced a 49% growth, driven by contracts with customers that have increased by 61.7%. Furthermore, the adoption of the gene-to-protein platform has led to a 14.8% revenue increase, while ongoing investments in automation and digitalized production workflows have contributed to sustained growth. In addition, the company's expanded engagement with global pharmaceutical and biotechnology customers has driven sales growth, as has the successful launch of innovative products. Continuous sales growth from key accounts and expansion into global markets have also played a crucial role in revenue growth. Moreover, license revenue has continued to increase, with milestone payments for achieved milestones and sublicense revenue from anti-PD-1 single domain antibody contributing to overall growth. On the other hand, primary drivers of revenue decline include intense competitive dynamics and persistent pricing pressures in specific regional markets. Incremental costs associated with the launch of new production facilities have also had a negative impact on revenue. The life science segment has experienced a decline in biologics development, while the industrial services and products segment has seen a significant decline as well. The net income of the company underwent a significant change in the given period. Initially, it increased by approximately $194 million due to various factors. However, this increase was short-lived, as the net income decreased due to an adjusted operating loss of $3.2 million. A closer look at the profit margins reveals mixed results. The adjusted gross profit margin showed a decrease from 52.2% to 51.2%, indicating a slight decline in profitability. On the other hand, there was a significant increase in the adjusted gross profit margin from 15.1% to 66.5%. However, this improvement was not sustained as it decreased again to 39.6%. The reasons behind these changes are multifaceted. The impairment loss on investment in Legend Group of $398,071,000 recognized in 2025 had a significant impact on the net income and profit margins. Additionally, revenue increased by 14.8% and adjusted gross profit increased by 12.5%, which contributed to the fluctuations in profit margins. The company's operating cash flow has been a mixed bag over the years. While there have been instances where it generated significant amounts of positive cash flow, such as $143,219 in 2025 and $812 million in the same year, other periods saw negative results. For example, in 2024, the company reported no operating cash flow, and on page 16, a total net cash outflow of $880,391 from operating activities was noted. Additionally, on page 24, it was stated that the company's operating cash flow status is negative. This inconsistency suggests that while the company has had some success in generating positive operating cash flow, it is not a consistent trend. The company's debt level has undergone a significant change in the past year. According to the extracted summaries, the debt decreased by $668,982 from $4,443,291 to $3,774,309 on page 6. This indicates that the company has managed to reduce its debt burden. However, it is worth noting that there are no further mentions of significant changes in debt levels throughout the document. The interest expenses, on the other hand, have seen a notable increase. Specifically, the Probio Series B preferred shares and BSJ Series A capital increase have resulted in interest expenses of $2.9 million and $2.7 million respectively. This new information suggests that the company's interest expenses have increased significantly. The company's financial performance varied across different segments and regions. On the positive side, life science services and products showed strong revenue growth with a gross profit of $257,576,000 and a profit before tax of $133,741,000. The synthetic biology operation also performed well, generating revenue of $57,952,000 and a gross profit of $22,950,000. In contrast, the industrial biologics development and products segment struggled, resulting in significant losses of $682,555,000. Additionally, the investment in a significant associate led to a loss of $320,400,000. The biologics segment also incurred a loss of $186,556. Furthermore, within the industrial segment, revenue declined for biologics development services by $95,021 and synthetic biology products by $4,267. Overall, while some segments showed promise, others faced significant challenges, highlighting areas that require improvement to drive future growth. Management is optimistic about the company's outlook, citing robust growth across 3 major platforms and a strong transition from R&D to commercial delivery. The strategy emphasizes proprietary technology and platforms, accelerating drug development for customers through end-to-end solutions and collaboration with customers. The company aims to strengthen its role as a core infrastructure provider for biological discovery, advance next-generation gene-to-protein platforms, and scale up automation and digital manufacturing capabilities. Management anticipates continued growth into 2026, driven by in vivo service offerings, strengthening presence and client partnerships in China, and diversified capabilities. To achieve this growth, the company will focus on strategic capital allocation, efficiency improvement, and proactive risk management, aligning investments with industry trends such as automation, AI, and streamlined gene-to-protein workflows. This approach positions Genscript Life Science Group as a critical enabling platform for early-stage biological discovery, solidifying its leadership in the biotech industry. The company's financial strategy has been a topic of interest for investors and analysts alike. A key aspect of this strategy is its approach to shareholder returns. According to the provided information, one area where the company falls short is in dividend payments. Despite being mentioned on page 16, there is no indication that the company has paid dividends to its shareholders. In addition to dividend payments, another common way companies return value to their investors is through share buybacks or repurchases. However, our analysis reveals that this aspect of shareholder returns is also absent from the company's financial strategy. Concerns about inventory buildup or supply chain disruption are evident in the recent data. A notable decrease in biologics development services revenue by 20% suggests a potential issue with inventory management. This decline from $95,021 to $388,686 on page 31 indicates that there may be an accumulation of inventory, which can lead to financial losses and inefficiencies. Furthermore, the inventory turnover days have decreased from 50 to 44 due to ongoing lean management efforts in the supply chain, page 38. While this might seem like a positive development, it could also indicate that the company is struggling to manage its inventory effectively. The fact that they are actively working on improving their supply chain suggests that there may be underlying issues. Additionally, monitoring of regulatory burdens due to sanctions, import and export controls, and other trade control laws and regulations, page 48, may indicate potential disruption in the supply chain. This could lead to delays or even complete halts in the flow of goods, further exacerbating inventory buildup concerns. Overall, these indicators suggest that there are legitimate concerns about inventory buildup and supply chain disruption that need to be addressed. That concludes the financial summary for Genscript Biotech Corporation. Feel free to comment below, and I will be happy to answer them when possible.